Our esteemed guest presenter, Carly Garner, is an experienced commodity broker with DeCarly Trading, a division of Zaner in Las Vegas, Nevada. She is also the author of Higher Probability Commodity Trading, a trader's first book on commodities, Currency Trading in the Forex and Futures Market, and Commodity Options. She also writes a monthly column for Stocks and Commodities magazine. After graduating from UNLV as a magna cum laude, Carly jumped into the options and futures industry with both feet in early 2004 and quickly became one of the most recognized names in the business. Her commodity market analysis is often referenced on Jim Cramer's Mad Money on CNBC, and she is a regular contributor to TheStreet.com and its Real Money Pro service. So I know Carly's anxious to get together with all of you and begin her lecture, so Carly, take it away.
Thanks, Darla. As always, it's a pleasure to be here. I appreciate Trader Planet and everything that they do for the trading community and to help traders, beginners, novice, experienced, learn about new topics, or if they're starting from ground zero, basically learn the solid base so that they can hopefully at some point eventually feel comfortable about putting money into the market. Today, we're going to talk about trading crude oil. I know that generally speaking, most people want to talk about inventory numbers and supply and demand and those types of things, and obviously those things are important. They move the markets. Just today, an inventory report came out that was a lot more bullish than most people expected, and crude oil rallied $2 in a very short amount of time. So fundamentals do matter, absolutely, but today we're going to talk about some other things that might, in the bigger picture, might matter maybe a little more, or, in the long run, be a little more influential. So what you really need to know about trading crude oil. If this is the first time you've come to one of our webinars, or you haven't run into me before, my name is Carly Garner. I am a broker and a market analyst at DeCarly Trading in Las Vegas, Nevada. If you have any questions, comments, or concerns about anything that we talk about today, you can contact me here using this phone number and this email address, cgarner@decarlytrading.com. If you're on social media, we'd love to interact with you there. Check us out on Facebook, Twitter. My Twitter handle is @CarlyGarner, and we're even on Instagram. If you just search in either of those social media websites, just search DeCarly Trading and we should pop right up. As Darla mentioned, I write a monthly column for Stocks and Commodities, and I do write a couple of newsletters for our DeCarly Trading brokerage clients. DeCarly Trading is a brokerage firm. That's what we do. Our clients receive a couple of newsletters, Financial Futures Report, which focuses on Treasury trading, and E-mini S&P trading, those sorts of things. And then we also put out a commodity newsletter maybe once or twice a week with trading recommendations. My latest book is Higher Probability Commodity Trading. It's my fourth book. It was by far and away the most challenging, probably harder than all the other three books combined. Some of my other earlier books were more on the beginner side. Higher Probability Commodity Trading is meant to be an end-all be-all. It covers some information. The first couple chapters are basically prepping everybody to make sure everyone's on the same page, and then from there it starts to get a little more in-depth, and we do talk about some somewhat complex trading strategies and ideas. So if you're interested in anything we have to say today, or you're interested in learning about commodities, please check out the book. We worked really hard on it, and we're proud of it. Before we really get started in today's topic, we got to make sure that everyone understands that there is a substantial risk of loss in trading futures and options. It's not suitable for everybody. We're not guaranteed interest or dividends. We're speculating. It's not easy. You're going to have good days and bad days. The idea is we want to have more good days than bad days. One of the reasons we're talking about crude oil today is obviously because most of you here are probably speculators or interested in at least somewhat in speculating in crude oil. But generally, the reason most people care about crude oil is it plays a large role in our daily lives, whether we are intentionally speculating or not. It does. If you're talking about gas prices, the cost of goods, plastic is made out of crude oil, all of these types of things that we buy on a daily basis or at least a weekly basis are correlated to the price of crude oil. Also, the crude oil can move the stock market. Whether it's correlated positively or negatively shifts back and forth. Most people kind of assume that crude oil right now is positively correlated, meaning when crude oil goes up, it brings the stock market up with it. When crude oil goes down, it brings the stock market down with it. We saw earlier this year, crude oil was extremely weak, trading down all the way into the high 20s, and guess what? The stock market just tumbled right along with it. However, the correlation between these two markets changes all the time. In fact, if you look at correlation stats now, they're actually kind of unrelated. They're really not moving together positively or negatively at all. It's probably closer to random than anything. So there isn't much of a correlation now. Earlier in the year, it was positively correlated. If any of you were trading back in the mid-2000s, when crude oil was 100 to 150 bucks a barrel, we're talking like 2007-ish area, you probably know that the market was negatively correlated with crude, and I'm talking about crude oil and stocks. Every day crude oil went up, the S&P went down because people were figuring the higher crude oil is, the more expensive it is for consumers to drive around and travel, for businesses to ship goods, so on and so forth. And obviously that was assumed to be a negative for the economy. But last but not least, we are going to talk about crude oil today because it is the quintessential commodity. Everybody wants to talk about crude oil. Even before I was a commodity broker, when I went to school or work, people wanted to talk about gas prices and crude oil. All right, we're going to start with fundamentals. If you've ever followed anything of our other classes or you've read any of my books, you probably realize fundamental analysis isn't something that I am necessarily comfortable with using as an end-all be-all when it comes to speculating, but you should always be aware of it. I mean, there's, it's obviously going to move the markets eventually. And the reason I'm a little sour on fundamentals is you have to think of a couple of things. The information that you're looking at is always going to be delayed. It's just the nature of the game. And so just because fundamentals are bearish today doesn't mean the market's reacting to that today. The market's was reacting to the bearish fundamentals 3 months ago when that data was valid. So just keep these things in mind. Anyway, what is fundamental analysis? Fundamental analysis is the study of interaction between supply and demand to be used to predict future price movement. Ultimately, the entire concept of fundamental analysis built on the following two equations. So fundamental analysis, in a nutshell, should be very simple. If demand is greater than supply, prices should be high. If supply is greater than demand, it should put pressure on prices. It sounds super, super simple, but in reality, it's not. Supply and demand figures are quantifiable, but accurate statistics are not available in real time. Like I mentioned before, it takes a long time for these fundamental numbers to come out. Even though today we were getting inventory numbers, a weekly inventory report in crude oil, that we're assuming, hey, that's what the current supply is. And it's somewhat true, but it is lagging a week, and it's not necessarily purely accurate. You have to keep in mind there is some guessing going on in these types of things. And even if we did have extremely accurate supply numbers, do we really have accurate demand numbers? Probably not. So we can plug numbers into this simple and neat supply and demand formula, but in my opinion, they're somewhat meaningless. If you've ever taken an economic class, you've heard the term or the equation, garbage in, garbage out. These simple formulas become confusing at best and misleading at worst. In my opinion, I believe traders should combine fundamental analysis with chart work, seasonal patterns, the COT chart, which is the Commitment of Traders report, and market sentiment. I'm not saying ignore fundamentals, because obviously there's things you need to be aware of, but when it comes down to making your trading decisions and timing it especially, you probably don't want to use fundamentals. There are some traders out there, you've probably read a book by Jim Rogers, who's one of the most infamous fundamental traders, but not all of us have the deep pockets that Jim Rogers has. Jim Rogers can buy corn at $5 or $6 a bushel, and if it goes down to 4, he doesn't care. If it goes to 3, he probably still doesn't care. He can buy more, or he can just sit on it for a long time. So we're not Jim Rogers. Therefore, we probably shouldn't be trading strictly on fundamentals. We should look at some of these other things, and that's what we're going to talk about today. So this is just kind of a visual expression of what I'm talking about. Fundamentals, supply and demand, they do move the market in the long run, but in the short run, is it really going to help us that don't have unlimited trading capital or pure nerves of steel? Probably not. When people were talking about peak oil back in 2007, 2008, crude got up to almost $150 a barrel. At the time, people were I remember Goldman Sachs saying crude's going to 200, and I heard some 250s out there. So, we're talking some really wild speculation at that time because of peak oil. And if you're not familiar with peak oil, it was basically the idea that oil supply is limited, demand is high, and so there you go. There's no cap to where pricing can go. But fundamentals slowly changed, but the market quickly changed. We went into the financial crisis. Crude oil dropped all the way to $40 a barrel. In fact, it went into the 30s. All the while, peak oil is still a concern. There's still a limited supply of oil, right? Demand did go down, not nearly as much as this chart would suggest, but it did go down. So fundamentals matter, yes. In the long run, in the short run, maybe they're not so helpful. Okay, just to give you an idea of some of the things, if you do want to track fundamentals, what you should be looking for, the EIA, Energy Information Administration, puts out annual forecasts. Keep in mind, it's a government agency. The accuracy is questionable. I mean, just because you work for the government and you have access to a lot of data doesn't necessarily mean you can predict where the price of crude oil is going to be. In fact, I would probably argue that more often than not, they're incorrect. And you can't fault them for that. Nobody can see the future. But just be careful when you're looking at those annual forecasts. Take it with a grain of salt and do your own research. We also get weekly inventory data. The EIA puts out a report on Wednesday morning. It's available to the public. We had one today. It's a Thursday, but that's because this is a holiday shortened week. But the EIA number almost always moves the market, so you want to be aware of it. If you're an option seller, I've found, particularly if you're selling strangles, try to do it the day before the EIA weekly inventory report comes out. The options are usually a little more expensive. If it's a non-event, the implied volatility in the options drops a little. The API, the American Petroleum Institute, puts out a weekly inventory number every Tuesday evening, so it comes out the night before the government numbers come out. It's only available to subscribers. I don't remember what the exact cost is, but it's not necessarily cheap. It's pretty expensive. Some believe that their measurement tactics are more accurate than the EIA. Quite frankly, they probably are. And of course, there's OPEC. OPEC is the Organization of Petroleum Exporting Countries, and consists of 12 countries that work together for price collusion. They've been in operation since the 1960s. Luckily for us, U.S. fracking has really interfered with their power. They still can move the markets, trust me. It doesn't take much for crude oil to react to some random comment or rumor coming out of OPEC. So they still have a lot of clout, but that's diminishing as time goes on. Some people like to say that OPEC has been fracked along with U.S. shale, but they do still account for about 2/3 of the world's oil reserves and about 1/3 of production. So they're still obviously big players. Okay, let's get into some of the things that you may not be aware of, but probably will be a little more helpful in your trading. Crude oil seasonality. there are several seasonal trading services out there. I tend to prefer MRCI. There's also a website called seasonalalgos.com, I believe. It's pretty good. So if you search around, you'll find different services. They're all going to be slightly different in regards to their timing and suggestions, and I know that sounds weird because they're all using the same data, but they really aren't using the same data necessarily because, remember, futures contracts expire. So it's not as easy, unlike a stock that just trades consistently forever and you can simply look at where the high, low, open, close was of each and every day. It's not quite that simple with futures because crude oil expires every month. So every month you're dealing with a new futures contract. There's contango, so each futures contract is trading on a little different price level, and it honestly interferes with the accuracy of the data. So believe it or not, not all seasonal services are going to give you the same general answers. They'll all be pretty close, but they're not going to be exact. So just be aware of that. I would venture to say that the energy markets probably have the most profound and reliable seasonal patterns of all the commodity markets. This is a good thing because it makes them slightly more predictable than some of the other commodities. And I say slightly because please bear in mind, seasonality is not the holy grail. There's nothing magic about it. It's simply the idea of a commodity trades or behaves a certain way more often than it doesn't. But trust me, on years that it doesn't, it's completely counter-seasonal. If the seasonal doesn't work, it's usually pretty dramatic. Sometimes, even if seasonals do work, in theory, sometimes they're early, sometimes they're late. So as a trader, especially in the commodity markets where there's leverage, if you're trading on higher leverage than you should be, or maybe just trading on any leverage at all, you might find that if you're a little early to the party, you may not be around when the market actually does make the move you're looking for. In a nutshell, if you're looking at the big picture in crude oil, here's kind of how things generally work. And again, this is a general statement. This particular seasonal chart is based on the previous 15 years, and it's actually based on cash market. But the idea is refineries demand crude oil early in the year in anticipation of higher demand during the summer driving season. So right in here, you start seeing February and March, crude oil prices tend to go up. And again, this is because the demand for crude oil is actually well ahead of the summer driving season because it has to be refined first. It's not like crude oil goes straight to the gas station for you to put into your tank. There's a process. So crude oil actually gets its summer driving season rally in late February, March, April, and tends to kind of peter out here in May. The best bearish seasonal trade, so again, the best bullish seasonal trade will be looking for crude oil to do something on the upside early in the year. The best bearish seasonal trades are going to be looking for some sort of top in late summer going into the end of the year. So despite all of the noise and all the rumors and everything going on in crude oil, probably the most likely scenario that we'll see is any rally in crude oil will probably eventually be sold into, and we'll probably see crude make its way lower into the end of the year. Obviously, there's no guarantee this is going to happen, but that is the most likely set of events that, based on historical patterns. Have to be careful what I say here because I don't want anyone assuming it's easy money because it's obviously there's no such thing as easy money. But the higher probability trades will be to be bearish crude oil going into the end of the year. Okay, be aware of market sentiment. This is a big one. Most people really just simply don't pay attention to market sentiment, but they should, and here's why. It can be very telling. Most traders lose money and most speculators are inaccurate when it comes to price prediction. Probably because they're all following each other. If they turn on the TV and they read the newspaper and everything they read is bearish crude oil, they're probably going to be bearish too. You probably all remember when crude oil was trading in the 20s we were hearing crude oil $15, crude oil $10. It was almost impossible to find anyone that was looking for crude to go higher. But guess what? Just when everyone was bearish and everyone agreed that crude was going lower is exactly when it turned. Now, I'll be honest, I never thought it was going to get quite that low. We were looking for crude to bottom in the low 30s, and it just kept going. But that's one of those things when, even though it kept going, eventually it turned around and rallied extremely sharply. So in the end, I guess you could say we were relatively accurate in trying to pick some sort of a bottom in crude, but it probably didn't matter for a lot of traders because most people didn't have the money to hang on. So even if they were bullish and they were right, they may not have actually made money on it, and that's frustrating. In fact, they probably lost money on it. I know there were a lot of margin calls hitting the desk in the early part of the year because not only was crude oil plummeting is the best word for it. Stocks were almost in free fall, and so commodity desks across the country were taking a lot of heat, and margin managers were stepping in. So anyway, back to the subject. If most traders are losing money and most speculators are inaccurate, why would we follow the herd? Well, that's a good question, but unfortunately, it is human nature. Most people do follow the herd. They simply jump on the bandwagon, particularly in oil. For whatever reason, oil is a big bandwagon commodity, but that's usually not the right play. If you want to know what the market sentiment is, there's a couple things you can do. You can tab the board for clues, and what I mean by that is read business newspapers, watch business news stations, check out internet newsletters, online forums. Another place you can look is there's a service, it's called Consensus. We offer a free trial on our website if you're interested, and it basically will tell you through their independent research the percentage of people they believe are bullish in certain commodities, crude oil being one of them. And so it's interesting when you see that most traders are bullish, you can kind of usually look for some sort of a reversal. If you see most traders are bearish, then it usually means some sort of bottom is at least close. Obviously, that's a contrarian view. That's kind of the opposite of what most would assume. If most people think if everybody's bullish, then they should be bullish. That's not always true. So you want to be really careful about that. Sometimes if you're becoming bullish after everybody else already has, you're simply being thrown out to the wolves. You might be buying the highs or selling the lows, and that's never fun. So another thing we look at when we're trying to decide what direction we think crude oil might go is the Commitment of Traders Report. The COT report is issued weekly by the CFTC, which is the Commodity Futures Trading Commission. Basically, they compile data on traders holding open positions in the commodity markets. They split them into two major categories, the reportables and the non-reportables. Reportables are the big guys. They are the smart money. Specifically, they are the people that are trading in excess of reportable limits set by the CFTC. In most markets, the reportable limits are very high. We'll talk about crude oil's limits in a minute. But anybody that is trading a high number of contracts in excess of the reportable limits will fall into categories. They're either commercial hedgers or they're large speculators. The large speculators are considered the smart money. Non-reportables are those that are trading beneath the reportable limits, and quite frankly, it's probably all of us. We are the small speculators, and we are unfortunately the dumb money. The great thing about the COT report, it's a little different than the sentiment index that I was talking to before. The consensus sentiment index will tell us what traders or analysts are thinking, but the COT report tells us what traders are actually doing, where they're putting their money, and not their mouths. So the reportable limit in WTI crude oil futures, which is the crude oil that most of us are watching on the New York Mercantile Exchange, is 350 contracts. Now, to put that in perspective, the margin per contract is $3,190. So if you were trading the minimum to meet the reportable limit of 350 contracts, you would have a margin requirement of $1,116,500. So we're talking a pretty sizable chunk of change. Most people, or very few people, would completely max out their account in crude oil. So if they are trading 350 contracts, they're probably trading an account much bigger than $1 million. The $1 million is just their margin requirement. And to be honest, we've seen crude oil move, again, to put things in perspective, crude oil is worth, for future speculators, if you're trading the full-size contract, each penny is worth 10 bucks. So if crude oil moves $3 in one day, you made or lost $3,000. So you could see somebody trading the max leverage of 350 contracts, if they had $1 million, let's just say they roughly had $1 million in their account and crude oil was up $3, they would either double their account or blow out their account. And a $3 per day crude oil move is not that uncommon. I've seen crude move $7, $8 a day, so it can happen. Okay, so we talked about the margin, but let's talk about exposure. Each futures contract traded is roughly $47,000 worth of crude oil. That's assuming crude oil is trading at 47 bucks. So if you have a margin requirement of 3,000, I'm rounding, but you're actually exposed to the risk of $47,000 worth of crude, we're talking a substantial amount of money. So 350 contracts times 47,000, we're already up to $16.5 million roughly. So that's how much you would be exposed to, how much risk you'd be exposed to if you were trading 350 contracts. So I'm just trying to point out the large specs or the reportables are trading a pretty decent chunk of change. The things that I look for in the Commitment of Traders report are, I look for overheated markets. There are, particularly when you're looking for overheated markets, you want to look at large speculators. If large speculators, remember that's the smart money, are holding record net long or net short positions, it's generally a sign that the trend is coming to an end. It's almost like, everybody's already acted. Everyone's already bullish. They've already put on their positions. They're already in the market. So the buying dries up. Obviously, the same thing can happen in the selling. And a lot of times, the trend will violently reverse. And one thing to keep in mind, when these types of things happen, it's kind of like there's just too many people in the bus. It gets overloaded, and something has to give. A lot of times, these reversals will happen on absolutely no change in fundamentals. I remember natural gas a few years ago. We were trading, I think, somewhere in the low $2. Everybody was bearish because natural gas was in a huge glut, and actually it still is. At the time, a lot of natural gas producers were actually flaring natural gas, meaning they were just burning it because it was cheaper to burn it than to actually bring it to market and sell it. So fundamentals were just dramatically bearish. But we got to a point where everybody was short and there was no one left to sell. So suddenly, the market started to boom. We went from $2 to $6 or $7 over the course of maybe a couple of months. And most of that, not all of it, but most of that was done on short squeezing and short covering without any change in fundamentals. So these are definitely things you want to keep an eye out, and you're not going to learn about any of this stuff in the, looking at the supply-demand numbers and in the Wall Street Journal. You don't want to be caught in a market that's too long or too short. Another thing you can look at in the COT report is following the smart money. Now, there's a few things to keep in mind. You don't want to follow them after they've already made a big move. Like I just said, you don't want, if all the large specs are long, you don't want to be a buyer then. But if you notice that the long specs are going from short to long and a trend might be just budding, maybe it's time to consider joining in. But there's also another thing to remember. They have much deeper pockets than we do. They can take more pain than we can. Some of them are trading their own money, but some of them are managed money. So some of them are money managers, and it's not even really their money. So they can probably take a lot more pain than most of us could. And the reason that matters is you'll notice that sometimes the large specs will start putting a position on, and it'll go against them. They'll eventually be right, but in the meantime, it could go against them substantially before they're proven right. Well, the average small trader or a small speculator probably wouldn't have enough money or the wherewithal to ride that out, where the large spec might have. Okay, this is an example. I'm sure you've all remember a couple of years ago when crude oil peaked out around the 110-ish area. At the time that happened, we had gone out and we actually did a segment on Mad Money, and we'd written a couple newsletters, and we said, hey, this market is an accident waiting to happen. There are way too many longs in this market. There were more people long crude oil at that point than ever in the history of crude oil futures. So we knew something had to give. Of course, we don't ever know when or where that's going to happen, and we never know how far it's going to go. In fact, regretfully, we got caught on the wrong side after the big sell-off. We thought it was done somewhere in the 70 area, and then obviously it was not. But looking back in hindsight, it looks so simple, right? There's just too many longs, and at some point, the buying was going to dry up. There was going to be some sort of shift in climate, and the rest is history. Another thing that people tend to overlook, which is a mistake, and it's such a simple concept, is currencies. Currencies do matter. It's easy to forget, but crude oil is priced in dollars. So when the dollar moves, it changes the value of crude oil, and it's really that simple. When the dollar is higher, it puts pressure on crude oil prices, but a lower dollar will support prices or push them higher. And it doesn't take, with all else being equal, let's say supply-demand doesn't change, seasonals don't change, let's say everything else is equal, when the dollar moves, crude oil value changes. And if you don't believe me, look at a chart. This is a chart that goes back from like 2010 to 2016, so it's a pretty good sample size. And you'll notice, there are times where they go kind of do their own thing temporarily, but for the most part, the major tops and the major bottoms coincide with each other. So you can see right here, by the way, crude oil is in the blue, and the dollar index is in the black in the bottom. So we see the dollar peaking out and crude oil bottoming. Here we see the dollar bottoming and crude peaking. Here we see in 2014, 2015, the dollar made a miraculous run, surprised a lot of people, and it immediately put pressure on crude oil. So when people say that crude oil tanked because of fundamentals, that's probably partly true, but a big part of it was simply the dollar weakened. And we can see all the way down here with crude getting down to 30 bucks, a lot of it has to do with the dollar. Now you will notice that sometimes, although this correlation is probably always going to exist, sometimes one will move before the other. So you have to keep in mind, if you start seeing the dollar really take a dive, you might, and crude oil hasn't reacted yet, you may want to consider putting some sort of speculation on that is looking for crude oil to go up, or vice versa. Okay, I wanted to thank everybody for coming today. I hope that you got at least something that will help you as you trudge along in the markets. If you're interested in learning more about some of the other commodities, like we talk about seasonals and COT report and all that kind of stuff in my book concerning a lot of the other commodities, please feel free to pick a copy up. You can get it at any major bookstore. It's going to be cheapest at Amazon. Free shipping, that's great. Amazon's pretty cool. It's on Kindle. If you have any desire to access free educational material, we have a lot on decarlytrading.com. And if you have any questions, you can go ahead and type them into the question box. If I miss anything, or you go home later, or sorry, you shut your computer off and you think of something, you can email me or call me. Here's all my contact information. Okay, I'm going to start answering some of these questions. Someone's asking if I write about technicals in the book. Yes, I absolutely. There's an entire chapter devoted to technicals, and I give away some of the indicators that I look at, how I think maybe they're best used, so on and so forth. Similar to what we did today, in the book we do provide some seasonal studies on most of the major commodities. We go into a little more depth in COT, commitment of traders analysis. Okay, someone's asking, do I keep my clients up to date on COT report trends? That's a good question. I would say, we write a newsletter called the DeCarly Perspective that focuses on commodities. I write that about once a week. It just depends on what I see in the markets. If there's enough to write 2 of them in a week, I'll do 2. If there's nothing to write, we'll skip it. But in that particular newsletter, I do try to mention COT and keep people posted. If I see something extreme, I say, hey, this is what we're looking at. This is what we're thinking might happen as a result, so on and so forth. Someone's asking if we should see 35 in crude oil again before the end of the year. It's a bold statement to say that, but my guess is we probably will see the mid to high 30s. There's always that what if that could change things. Maybe OPEC will come out and surprise us with a production cut or something like that, and that would definitely flip things around. But fundamentally, I don't think things have changed enough for crude oil to avoid the seasonal tendency, which is generally lower through the end of the year, as we mentioned. I tend to believe we'll see the 30s again, yes. Okay, somebody's asking if we do mostly weekly or monthly options. Most of the recommendations that we make are in the monthly options. We do have clients that trade weeklies rather frequently. It just depends on the market. Some of the commodity markets offer weekly options, but they're on the thin side. There's not a lot of volume in them, so you have to kind of be careful. I think the weekly options are probably better for option buyers, not option sellers. And the reason being, they're a lot cheaper because they expire sooner, generally. Unless you're buying a weekly option for next month, but that's a different story. So they are cheaper, which is great. But as an option seller, you tend to be collecting a moderate amount of premium and getting pretty close to the flame. So I'm not sure that's the best idea for an option seller. But as an option buyer, I think it's a great way for a swing trade or a short-term, maybe even a day trade with low risk. Worst case scenario is you buy a cheap option and it turns to pixie dust, which happens to options a lot. But at least you know your risk and you know it's limited. Okay, do we have any other questions, comments, or concerns? Somebody's asking what my guess is on the high of crude oil for now. I'd be surprised to see it go over 50 bucks, but you know what, crude oil surprises me all the time. It's the kind of market that there's just no limits to the chaos. Even when it's probably not going to last. A few weeks ago when crude was rallying sharply, we'd kind of accounted for the idea that an oversold bounce was probably in the cards, but we were looking for something 46, 47 area at the most, and then sure enough it goes almost to 50. So and it came right back down. So it wasn't true price action, but that doesn't matter when you have money on the line. So you have to be careful with crude. You should always give it more room than you expect. So if you think 50 should hold, you should put together a strategy that gives you room up to 52. Because guess what? Crude oil is just one of those markets that can be sadistic. Okay, in the book we do have a chapter. Somebody's asking if we talk about day trading and swing trading in the book. Absolutely. There's a chapter on day trading, and just my personality and what I've seen over the years, I prefer swing trading to trend trading or some of the other strategies, and so we outline that quite extensively in the book. Someone's asking what I think about the Alpine High discovery. To be honest, I don't have a real strong opinion just outside of my scope. I tend to focus on seasonals and COT and charts, and I don't try to bog myself down with that sort of thing. That doesn't mean that there's not valuable information. I know some traders that trade only on fundamentals, and they do a good job of it. So it's just a matter of finding where you think you have an edge and what you're comfortable with. Someone's asking if I think that technical patterns are reliable for crude trading. I do. I think that, like I mentioned before, crude oil can be a market that goes to extremes, and sometimes understanding what that extreme might be is difficult. But In normal market conditions, yeah, I think it actually is, plays by the book for the most part. Someone's asking what are some of my favorite patterns. You know, I actually talk about this a lot in the book. The way my brain works is I like to keep everything very, very simple. So I like triangles, trend channels, trend lines, super, super simple. Then I put that together with some indicators, some seasonals, some other things, but super simple. I've had very little luck in getting real complicated with things. I mean, some people pull up a chart and they have angles and lines everywhere. In my opinion, it's kind of like if you put enough lines on the chart, some of them are bound to hold. But is that going to really help you in trading? I'm not so sure. It probably wouldn't help me. So again, just find what works for you and what you like. Okay, I appreciate everybody coming out. It looks like we've answered all the questions. If you forget something, please give me a call or send me an email. Hope to see you next time.